All right, let's talk about Porch Group. They just had earnings and we got a whole lot more coloring on what to expect in 2026. And we saw the growth lever finally being pulled. And money shirt on today. That's what's causing stock price to increase by quite a bit. 14.6% as I'm recording this video. This means that, year to date basically break even. It is what it is. The stock got caught in the SaaS apocalypse. And they released earnings onto another red day. You can see the Dow Jones here, the S&P 500 all down, but tech companies falling big time today as well. So some bad macro that Porch is reporting into. Nonetheless, a very strong performance and stock price reacting accordingly. So why do we see such an increase? Market cap now roughly 1.1 billion, so keep that in mind as we walk through the numbers together. So I was up late last night reading through this press release that they released before the earnings call. And then roughly 30 minutes later they had the presentation. I know some of you guys were also up there with me watching, commenting on the Discord channel as it went through with the earnings calls. So some of those highlights here that I'm going to cover today will not be something new for those of you who followed along there. So, all right, in terms of Q4 performance, revenue was very strong. We can see that in terms of revenue, they generated $112 million. That was attributable to Porch Group shareholders. And we saw adjusted EBITDA basically 11x since Q4 of the same year last year. And as professional investors, what does this tell us? Well, it tells us that the unit economics are there. We saw a lot of questions at the end of the earnings call where, for example, the different analyst houses, they were asking management, are you certain that this is scalable? Just trying to fish to see, are the numbers that we have in place right now today going to be able to continue to scale as we go into 2026? And this is extremely important because we see strong unit economics right now. We want to see that continue as they aim for 600 million in the written premiums for 2026, and put that into consideration when you see current market cap of 1.1 billion and the strong profitability that Porch Group has. We will see more on this in this earnings report here. So all in all, numbers looking very strong, and this stock is getting more on the radar as well. As I followed along, in the pre-market, I saw up 20%, something like this. I saw analyst coverage, people adjusting, and I saw that, Goldman Sachs also initiated coverage on this stock quite recently. So it's getting more and more on the radar in terms of institutions. So it's not only you and me, the good old retail traders, who are competing for shares. It's also institutions getting this company on their radar. So all that work going to different non-deal roadshows, so the investor events, has paid off and the company is getting more coverage. All right, let's take a quick look at some of the numbers here so we can see it being divided into different segments. Insurance is a major part now. Software and data and consumer services is still seeing headwind due to the slow housing market, and in terms of guidance for 2026, management does not seeing this going anywhere, and frankly neither do I. The property market for just personal properties seems to be just in a stalemate. No idea what's going on there, but hopefully that market heats up sooner rather than later so that people can move around and people find houses, the millennial, the Gen Z generation. Anyways, not gonna go off topic on that. We see growth here 24%. So all these numbers are in million, by the way. So 124 million, as you saw earlier in this report. Gross profit on this 95 million. Very nice. And then we see the Porch shareholder interest here, adjusted EBITDA, so earnings before interest, taxes, depreciation, and amortization. 23.5 million. Very, very solid numbers. And then cash flow from operations, 1.2 million for the quarter. And they have used a bunch of cash in this case to pay down debt as well. Only a few million left on the last maturity for 2026. And that comes to maturity in September, those notes. So the company is aiming to settle those notes on maturity date. Definitely very, very doable. No risk there. CEO summary. Yes, it was a pivotal year. It was a big transformative year in terms of them changing the business model to more commission and fee based, taking a lot of risk off the table with the new reciprocal exchange. Finally getting that to lock in for the OGs who have followed along for a long time. You might remember that they tried to do this, but the reciprocal that they signed up for had big troubles. There was a lawsuit and they were at risk of catastrophic weather events. Once again, seeing absolutely huge swings in share price. Swings are still huge, but it was a lot wilder back then. If you want to take a look at massive risk, take a look at the stock analysis I do at Hippo a bit later on. They are still exposed to cats, but nice to see that the insurance tech, the whole area, is getting a bit of an uplift. It has been good. There was some very bad times back in the day for this whole entire sector. If we look back here at 2021, when the whole market got re-evaluated, and it's not the same company anymore as back then. Numbers now look a lot better and more undervalued in terms of how the market valued companies like Porch in the past. So eventually, I'm sure sentiment will swing back to being more bullish. It still is, and we're still early on in this journey. The company has a lot more to go. Like Matt Ehrlichman, the CEO, commented on late in the earnings call, we're a small company, basically just doing in Texas, where they have the majority of their policies being written. There's a lot of more growth levers to be pulled, and they pulled a lot of those today. I have to mention this, I already mentioned this, so 600 million of reciprocal written premium, that's the goal, so a 25% year-over-year organic growth. Some strong numbers, and in terms of looking at the surplus that they have, which is very important for insurance companies, they do have the amount to cover this growth. There was some worry because the surplus in some way is tied to stock price as well, and if we take a look at Porch stock price and just look at the latest time here, it was at 18, something like this. The CFO, Mr. Tabak, commented on this as well, and we saw that it dropped down significantly, and this apparently just affected a little more than $10 million in terms of liquidity for the reciprocal. So not a huge effect. It will not hinder premium in any way. And if share price increases by a lot, well, it will give a small boost to the amounts of premiums that they can do. But they have the liquidity to scale growth and support that growth. So management was very, very confident in this regard. I think they exuded a lot of confidence in the earnings call. So that out of the way, let's take a look at the growth. They finally pulled the growth lever. I was calling for this earlier in Q3. We was disappointed. We did not see them onboarding a lot of agencies. and we saw stock price being punished as a result of this, I don't mind, like in terms of the value, the return on investment that Porch has given me, it has been greater than my salary for 2 years in a row now. And I trust management. Take all the time you need in terms of this, grow sustainably. I don't want to have to sell my shares and invest them somewhere else. I want to feel confident that my capital is in good hands. And after this earnings call, that's exactly what happened. I feel a lot more confident that, the dollar bills is in safe hands, basically. So top funnel momentum, this is the revenue, that's the top funnel, then profitability, the bottom line, right? So it continued in Q4 2025, active agencies and quotes each rising more than 100% from Q4 2024. And we saw a specific slide about this in the earnings call. And we saw that the amount of onboarded agencies was a bit larger than the amount of quotes, just in terms of the ratio. And the reason behind this, we got it all explained to us, is because some of those agencies was onboarded late in the quarter, so we will only see the return on that in Q1. And as a shareholder, looking at where the stock is today, the total market cap of the company, the growth, and how they are poised for growth in Q1, this makes me sleep very easy on Porch Group right now. So we see this, it's called a leading indicator, so it comes before revenue. For example, if you look at Duolingo, who's another popular stock, you will see bookings there. That's a leading indicator. And then, they take that $80 and they split it and just realize a quarter of it every quarter. That's the rule of how revenue is realized. That's a leading indicator. In the case for Porch Group, I argue that the amount of onboarded agencies in this case, is a leading indicator, because more agencies means more quote volume, which means more revenue. So that's, even wider funnel at the top line, and they are finally doing this, finally feeling confident enough to pull this lever so that we can see great revenue increases independent of the company needing to raise premiums on insurance. It's been an amazing environment for insurance companies. Premiums have gone up. It's a debate in America today. It's quite expensive. They mentioned this on the earnings call as well. We've been talking about that on the channel for quite some time, but nice to see that revenue projections are not dependent on increasing premiums. And as a matter of fact, to take more market share, they argued that they could give cheaper policies to lower risk homes. And that makes perfect sense to me. If you write a policy for a home and there's never a claim, that's just pure profit at the end of the day. And if the software, the home inspection software, can help identify these properties, makes perfect sense. And that's why we see this amazing loss ratio that they have. And with that said, the question once again, is this scalable? How scalable is this? Well, time will tell. As for now, just a signal of strength. As for Q1, this gives me great confidence in that quarter, given the leading indicator of more agencies being onboarded in this case. So top funnel. All right, so gross written premium increased. We saw this acceleration, of course, with the targets. Q4 2025 statutory surplus at a reciprocal of 155 million, increased roughly 50 million here from Q4. So this surplus, I commented on it a bit earlier, that the decrease in share price did not really have a significant impact on this. So very, very nice to see. So insurance services KPIs, you can pause and read this if you want to. I will just mention very, very briefly in terms of consumer services, the software and data KPIs. So average numbers of companies will go down in this case. And I was very impressed once again with management in terms of the reason behind this. They are cutting the tail. Man, so great. I remember to talk about this. I took some notes before, plenty of them, to make sure that I cover everything I want to cover. But cutting the tail, where do we see this type of behavior? I've seen it before when I did an internship at a management consultancy company in Stockholm, and when I did some market research for another management consultancy company, the McKinsey's of the world. You take in consultants to a business. In my case, I was at an energy company, did a lot of due diligence at the business, see what works, where the profit's coming from, where the costs are. It's got a bit of a bad rep today, the whole industry, since it's basically just firing people. That's a meme today. But what I did at that energy project was just to make some slides to support the recommendation to cut the tail. These smaller companies that are customers that do not really drive profits in any meaningful way. Putting capital towards that is misuse of capital, in my opinion. It's not the most effective way. And by cutting that tail, you can put development resources, capital into more efficient areas, and it just frees up money, working capital, and human resources as well. And in some cases, we don't know if this is the case for Porch, these smaller companies even incur a loss in terms of how profitable they are for the company. So we see them cutting this tail of smaller companies and focusing more on larger companies, and that's where the money is at. So in terms of average numbers of companies in thousands, we see a slight increase here, although we saw a bit of a decrease quarter to quarter. Comparing the Q3 to the Q4 results, this is obviously taking a look at 3 months ended and year ended, but in terms of total amount of customers, a decrease. Very, very impressed. Did they take in management consultants, or are they just amazing managers? Who knows? Not glazing too hard here, by the way. They deserve it in this case. All right, so we can look at the balance sheet here unaudited. You can take a look at some of these if you want to. One of the things that I found interesting was more long-term investments that they put their assets into. We can see that one of the reasons why insurance is so extremely profitable for the insurance companies is that they have this large float of assets, the premiums being written before the whole period runs out and they renew. You can't just realize it as profit. It could be used for claims, but you have all this cash also on your balance sheet, all these assets. Do you just leave it be, or do you put it to use? Well, of course, you put it to use in long-term investments and short-term investments. And just a little side note in terms of the history of Berkshire Hathaway, Warren Buffett, he loves insurance companies. He used this float to sustain working capital and grow other businesses within Berkshire Hathaway. So it was just extremely cheap capital for all of those businesses and a great contributor to the success. So another reason why I absolutely love insurance companies, growing up reading that material, watching how a hero to many investors, managed his money, then we learned a lot about insurance companies in that case. Just a quick side note. So in terms of the guidance, let's take a look at this as well. So Porch shareholder interest 2026 guidance. So 419 million here for the full year. And then in terms of 2026, they are guiding somewhere between 475 and 490 million. So substantial growth, not something, amazing, but very, very solid numbers. Very safe numbers, in my opinion. I think that this is something that they are very likely to achieve, perhaps on the higher end of the range here in terms of growth. Depends on macro environment, of course. And then gross profitability continuing increasing here between 12 to 16%. So unit economics are there in this guidance as well, with adjusted EBITDA increasing here even greater than the revenue number. So very interesting to see how this one pans out, and they put a lot more of range in terms of the scope of adjusted EBITDA. They've done an amazing job in terms of cost control, in terms of keeping costs low. I'm extremely happy about this. This has been consistent. This is prudent management. And just a quick side note here as well. We saw that Matt mentioned that they are an amazing place to work and voted something. I tuned out, that's not what investor ears wants to hear. But we saw in terms of Glassdoor reviews that there was a lot of complaining from employees in the past. I think I made a video on this where they wrote typical big corporate behavior, and as an investor, that actually kind of impressed me, because the employees are calling it typical big corporate behavior in the reviews, and it's a tiny company, it's a micro cap, it's below $1 billion in terms of them, and they're running it like it was a much larger company already in terms of cost controls, in terms of being strict and not letting everything fly. A lot of smaller companies have a freer culture where everything goes. It's a bit more Wild West, but Porch Group seems to have strict cost control and running it like they're running a system. So just as a side note, that gives me greater confidence that they are indeed going to be able to scale this profitability, scale these unit economics. I mean, we've seen them do this cost control for years now. Why shouldn't they be able to continue to do that in the future? And then as revenue grow and they control costs, well, then we get these type of numbers. It makes perfect sense to me, All right, revenue growth, this number, and then adjusted EBITDA, an even greater number. This is what happens when you increase revenue. You have your fixed costs being the same, and you don't have a whole lot of variable costs either. Of course, they could pull a lever to decrease the bottom line, use more of cash on hand as incentive for agents to write Porch Group insurance policies, although this is more of a flywheel. You get more written premium and you make more money, you have more money to give out as incentive to agents, so it's all just a positive flywheel in this case. And they have a new product as well, Porch Insurance, more of a full scope insurance where they just bundle together some more services to make it very, very easy for people moving in, signing that home insurance. Just all in all consumer centric, and that's something that you really want to see. If it's a good product, a good service, word of mouth is gonna spread, and that's free growth, that's cheap growth, that's like building a brand. If people know about it, have heard about it, turn to you from word of mouth, that's the cheapest type of customer. Then you don't need the agent to call out independently, they go to your website and sign up. That's fantastic in my opinion. So, and this guidance, of course, being based on current market conditions, assumptions. 2025 was a normal year in terms of weather effects, catastrophic weather events. Very, very normal year. Catastrophic weather events will hurt profitability to some extent, but it can't crush the business, because of the reinsurance. So losses from that can only hit a certain cap. and then no more, basically. So not a huge risk anymore. The losses from that, from claims, is going to be more streamlined, more predictable. Of course, we always hope for nice weather. It's not nice when somebody's home gets destroyed, and if they have amazing weather, well, then profitability is going to be a bit on the higher end. So we will see, it is what it is. That's the uncertainty of doing business. So a nice conference call all in all. Made sure to listen in. Plenty of questions from analysts, especially with regards to how scalable the current model is. I think I laid out a good amount of evidence as to why I, as an investor, believe that the company has a scalable model, based on previous behavior that I have seen. We will see when the market catches on. As for now, I think that stock price is still undervalued in terms of where we are today. In terms of year-to-date performance, we saw a strong quarterly earnings report, and we're still down year-to-date, with the S&P 500 being up just a little bit. And yeah, we have 3 more quarters to go in 2026, where we're going to get reports, and then obviously the first quarter in 2027 we'll learn how Q4 of this year went. So always looking forward to that. Anyways, that's been it for this video covering Porch Group. The earnings call. Feels amazing to finally have some news around Porch, something to talk about. It's been a bit of a drought for a long time, so finally being able to deliver a proper analysis for you guys on this company. Alright, that's been it for this video, and as always, hope you guys make a ton of money, whatever investments you decide to make. Take care now, bye bye.